Hey everyone, and welcome back to the Deep Dive. Today, we're going to tackle something that a lot of people find pretty intimidating,
Hmm.
investing. But especially for those who are just starting out,
Right.
it can feel like a pretty overwhelming world to try to get into.
Yeah, I can definitely see that. And it's something we hear a lot.
Right.
A lot of people in Italy
Mm-hmm.
either kind of go all in and take a lot of risks with their money and they end up losing it,
Yeah.
or they're so afraid of losing money that they just don't invest at all.
Right. And maybe that's even worse.
Yeah, exactly.
What if doing nothing with your money is actually riskier
Yeah,
than putting it to work for you?
it's true.
Right. So break this down for you. Like, why would keeping cash be considered risky? Isn't cash like the safest bet?
Well, I mean, it might seem that way on the surface, right? Because you think you're holding on to it. But the
Okay.
truth is that cash loses value over time
Okay.
because of inflation.
Mm.
And a good example of that is, let's say back in 1980, you had 100,000 euro and you decided to keep that in cash and just hold on to it until today.
Okay.
If you did that today,
Yeah.
that same 100,000 would have lost nearly 30% of its purchasing power.
Oh, wow. Like a third of it's just gone.
Gone just because of inflation.
So even if you're not even touching the stock market,
Yeah.
your money is still shrinking.
Yeah, you're actually losing money by holding on to cash.
Wow. Okay. That's scary to think about. And so right now,
Yeah.
we're seeing these negative yields on certain European government bonds.
Right.
And like these are considered among the safest investments
Right.
out there.
Exactly.
Yet investors are willing to take a small loss
Yeah.
just for the perceived safety of those bonds over cash.
Uh-huh.
So it sounds like even cash has its inherent risks.
Yeah, definitely. And we talk about the bail-in risk,
Yeah.
which is where, if your bank goes under, you could lose your savings.
Right.
But you're saying that there are also these like less obvious dangers
Yeah.
to just keeping a pile of cash.
Right.
Absolutely. So like what if it gets stolen?
Yeah.
Or what if you lose it? I mean, especially if you're keeping it at home,
Right.
there's really no recourse for that.
Yeah.
And then there's also the thing called opportunity cost,
Okay.
which basically means while your cash is losing value, you're also missing out on the potential to grow it
Right.
in the market.
So, okay, we can't just stuff our mattresses with cash.
Right.
What is the right way to think about it?
Well, I think, it is true that you need some cash.
Okay.
You should think of cash as your safety net.
Hmm.
It's that emergency fund
Okay.
that you need to have there in case something comes up so
Right.
that you can cover, unexpected expenses or whatever it may be.
Right.
But the key is to find that sweet spot.
When you say sweet spot, what do you mean? Like how much is too much?
Right. So it's all about balance.
Yeah.
You don't want to have too much cash sitting around because it is going to lose value to inflation. But you don't want to have too little cash because then you're vulnerable
Oh.
to anything that might happen.
You don't want to be caught off guard.
Exactly.
So you're saying it's a balancing act.
It is.
And I know that a lot of people rely on financial advisors to kind of help them
Sure.
navigate these decisions.
Yeah.
What are your thoughts on that?
I think financial advisors can be helpful, but you definitely have to be careful.
Oh, really? Why is that?
Yeah, because there are some pitfalls.
Okay.
The financial industry, unfortunately, has a lot of conflicts of interest.
Okay. What would be an example of that?
So let's say you have an advisor who is getting, a bonus for selling a specific product.
Hmm.
Even if that product isn't really the best thing for you, they're going to push it on you anyway.
Wow. Okay.
Or you might have an advisor who's just not well informed and
Yeah.
giving you bad information.
So how do you, as an investor,
Right.
make sure that you're getting the right advice?
Well, I think the most important thing is to be an active participant
Sure.
in your financial life.
Yeah.
Don't just blindly trust
Yeah.
what an advisor is telling you.
Yeah.
Do your research.
Mhm.
Check the facts.
Right.
There's so much information available these days
Yeah.
about different investments. Like, read those official documents
Okay.
and really make sure that you understand what you're investing in.
So it's about being informed
Exactly.
and doing your due diligence.
Yeah.
What would be an example
Okay.
of a scenario where this would be helpful?
So let's say your advisor recommends a particular fund
Okay.
that has a really high fee.
Mm-hmm.
But then you go and you do your research and you find out that there's another fund
Yeah.
that's very similar but has a much lower fee.
Okay.
That's the one you want to go with because those
Okay.
fees can really eat into your returns over time.
Wow. So it really pays
Yeah.
to do your research and to be informed.
Yeah, exactly.
So it's all about understanding where your money's going.
But
And why.
Exactly. And that brings us to another important topic, which is the difference between passive investing
Okay.
and active investing.
Right.
Yeah, and passive investing has become very popular,
Yeah, it has.
especially with low-cost ETFs.
Yeah. So what are the advantages to passive investing?
Well, passive investing basically means you're following a specific market index,
Okay.
like the S&P 500.
Okay.
And the goal isn't to beat the market. It's
Yeah.
just to match its performance.
Right.
And the interesting thing is there's a lot of evidence
Yeah.
that shows that the vast majority of actively managed funds
Okay.
actually underperform their benchmark indexes over the long term.
Okay, wait. So you're saying that like those experts who are trying to pick stocks
Yeah,
and beat the market
right.
are actually doing worse
Most of the time.
than if they just follow the market?
Yeah, it's incredibly difficult to consistently beat the market
Okay.
over long periods.
So for most people, passive investing makes more sense.
Yeah. Right. And you're also like, with actively managed funds, you're paying higher fees.
Right.
And those fees eat into your returns.
Okay, so passive investing, you're basically just riding the wave
Right, exactly.
of the market.
Yeah.
Okay, but what about people who want to like DIY it
Yeah.
and manage their own investments?
Sure.
What are some of the pitfalls to avoid?
Well, one common mistake is putting all your eggs in one basket.
Okay.
So, concentrating your capital in just a few stocks
Mhm.
can be really risky
Okay.
because if those stocks don't perform well,
Yeah.
you can lose a lot of money.
So diversification is key.
Absolutely. Yeah, you want to spread your investments out
Got it.
across different asset classes,
Right.
like stocks, bonds, real estate.
So it's not just stocks, it's like the whole investment landscape.
Exactly. You want to build a diversified portfolio.
Okay, and what about like listening to the news?
Oh, yeah.
Like, getting those hot stock tips
Right.
from friends?
Yeah, that's another trap to avoid.
Why is that?
Because the market is incredibly complex
Yeah.
and there's so many factors that influence asset prices.
Okay.
Relying on news headlines or rumors
Right.
can lead to really impulsive decisions.
So it's about like tuning out the noise and,
Yeah.
and focusing on like the underlying fundamentals.
Exactly.
Okay, that makes sense.
Yeah, and that brings us to another important point,
Okay.
which is the psychological aspect
Oh, interesting.
of investing.
Yeah.
There are a lot of psychological biases
Okay.
that can really sabotage your success.
What would be an example of that?
Well, one classic example is what's called the Dunning-Kruger effect.
Okay.
And basically what that means is people who have limited knowledge in a
Mhm.
particular area
Okay.
tend to overestimate their abilities.
Okay. So they think they know more than they.
Exactly. And this can lead to overconfidence
Mm.
and really risky behavior.
So it's that classic, like, just enough to be dangerous.
Exactly.
Yeah, you need to be aware of your limitations
Okay.
and approach investing with humility.
So what about market predictability?
Yeah.
Like a lot of people think
Right.
that, they can time the market or they can
Ah.
predict
Yeah.
what's going to happen with a particular stock.
Right. Well, the truth is that timing the market
Yeah.
is incredibly difficult,
Okay.
even for professionals.
So you're saying it's basically impossible to know?
Pretty much. Yeah.
Yeah.
I mean, it's just so many factors
Yeah.
that can influence the market.
What about, people who try to predict
Yeah.
specific events?
Right. Well, I mean, you can try, but it's very risky.
Okay.
And I mean, a good example of that is the recent market downturn.
Okay.
A lot of people rushed into oil
Okay.
thinking that the price was going to skyrocket,
Right.
but, that didn't really happen.
So it didn't work out for them.
No, and a lot of people lost money.
Wow. So even when things seem predictable,
Right.
that's not always the case. Exactly.
So how can we navigate this uncertainty?
Well, I think the most important thing is to take a long-term perspective.
Okay.
The data shows
Yeah.
that the risk of losing money
Mm-hmm.
decreases significantly
Okay.
when you hold investments for longer periods of time.
So it's about being patient
Exactly.
and riding out those ups and downs.
Yeah, it's about having a plan
Okay.
and sticking to it.
And what about leverage?
Leverage.
Yeah, like using leverage
Right.
to boost returns.
Well, leverage is a very risky thing
Okay, why is that?
because it can amplify both your gains and your losses.
Okay, so it's a double-edged sword.
Exactly. And for most people,
Yeah.
it's best to avoid leverage.
Okay, so stick to the basics.
Yeah.
So I think what we're really talking about here is the
Okay.
difference between
Right.
investing
Mhm.
and gambling.
Exactly.
Right. And I
Yeah.
think that's a really crucial distinction
It is.
for people to understand.
Absolutely.
So break that down for me.
Okay, so investing is about making deliberate, calculated decisions
Okay.
based on solid principles,
Yeah.
thorough research,
Yeah.
and a long-term perspective.
Yeah.
You're basically allocating your capital
Hmm.
to assets that you believe
Yeah.
will appreciate in value over time.
So you're making informed choices
Right.
based on like a rational
Exactly.
assessment of the risks and the rewards.
Yeah, it's about participating in the growth
Oh, okay.
of businesses and the economy.
And gambling is about.
Well, gambling is about taking a chance
Okay.
on an uncertain outcome.
Mm-hmm.
It's often driven by emotion,
Okay.
the thrill of the unknown,
Right.
the hope of getting rich quick.
So one is about building wealth strategically
Right, yeah.
over time.
Right.
And the other is about taking a shot in the dark.
Exactly. It's like, investing is like building a solid building brick by brick, and
Mm.
gambling is like rolling the dice.
I love that
Yeah.
analogy. So for someone who is ready to make that shift
Yeah.
from the gambler's mindset
Uh-huh.
to the investor's mindset,
Right.
where should they begin?
Well, I think the most important thing is education.
Okay.
Read books,
Mm-hmm.
read articles from reputable sources,
Okay.
explore financial websites,
Right.
attend webinars and seminars,
Okay.
talk to experienced investors.
So it's about like equipping yourself
Yeah,
with the knowledge
exactly.
and the tools
Yeah.
to really
Right.
make those smart decisions.
Right. The more you learn,
Yeah.
the more comfortable you'll become.
So you don't have to figure it out on your own.
Right.
There are these resources out there
Absolutely.
to help guide you.
Yeah, there's a whole community of investors
Really?
and experts who
Really?
are willing to help.
I like that. So it's about tapping into that community.
Yeah, exactly.
All right. So I think we've given our listeners a lot to think about today.
We have.
Any final words of wisdom?
Yeah. Investing is a marathon, not a sprint.
Okay.
So be patient,
Mhm.
stay disciplined, and always keep learning.
Great advice. Thank you so much for joining us
It's been my pleasure.
and for sharing your expertise and insights with us today.
Yeah.
This has been really eye-opening.
Glad to hear it. It really is. I mean, we talked about a lot of things today.
Yes, you did.
About, the risks of holding on to cash,
Yeah.
the importance of diversification,
Right.
thinking long-term, and even aligning your investments with your values.
Yeah.
So if you had to pick one key takeaway
Yeah.
for our listeners,
What would it be?
I would say that investing is a journey.
Okay.
It's a lifelong process of learning and
Mhm.
growing, and you should never be afraid to ask questions,
Right.
seek out information from reliable sources,
Right.
and don't be afraid to challenge those conventional investing truths that you might hear.
Right.
The more you know.
The better equipped you'll be
Oh, yeah.
to make smart decisions.
And I think that's something that we really hit on a lot today was, this idea of investing versus gambling.
Right.
And I think it's such an important distinction
Right.
for anyone who's new to this world.
Yeah.
So can you just kind of unpack that
Sure.
a little bit more for us?
Yeah. So investing is about making these deliberate,
Okay.
calculated decisions
Mm-hmm.
that are based on, solid principles,
Okay.
research,
Yeah.
and a long-term perspective.
Right.
You're essentially allocating your capital
Mm-hmm.
to assets that you believe
Right.
will increase in value over time.
So it's about informed choices based on,
Exactly.
rational assessment of the risks and the rewards.
Right. And it's about, participating in the growth of businesses and the economy as a whole.
And gambling, on the other hand, is?
Yeah. Gambling is about taking a chance
Okay.
on an uncertain outcome.
It's driven by emotion.
Yeah.
That hope of striking it rich quickly.
Okay. So one is about
Yeah.
building wealth
Uh-huh.
strategically over time.
Yes.
And the other is like a shot in the dark.
Exactly. It's like, investing is like building a house
Okay.
brick by brick.
Yeah.
And gambling is like playing the lottery.
Yeah.
You're just hoping to get lucky.
Okay. So for someone who is ready to move away from that gambler's mindset
Right.
and really kind of step into this world of conscious investing,
Uh-huh.
what would be your advice to them?
Well, my advice would be to start with education.
Okay.
Read books,
Mm-hmm.
read articles,
Yeah.
explore financial websites,
Mhm.
attend webinars,
Okay.
talk to other investors.
Yeah.
The more you learn, the better off you'll be.
It's about equipping yourself
That's
with
it.
the knowledge
Yeah.
that you need to make
Yeah.
smart choices.
Yeah. And, there are a lot of resources out there that can help you
Yeah.
along the way.
You don't have to figure this out
No, not at all.
all on your own.
There's a whole community of people who are willing to help.
Yeah. And so it's about like connecting with that community.
Absolutely.
All right. Well, I think this has been a fantastic conversation.
It has.
I've learned a lot today.
Good.
Any final words of wisdom?
Yeah. Just remember
Yeah.
that investing is a marathon.
Oh,
not a sprint.
Right.
Be patient,
Mm-hmm.
stay disciplined, and always keep learning.
Amazing advice. Thank you so much for joining us
It's been my pleasure.
and for sharing your expertise.
Of course.
And to our listeners, thank you so much for tuning in
Yeah, thanks for listening.
to this deep dive with us.
Absolutely.
We hope that you learned something new
Yeah.
and that you feel empowered to make those smart financial decisions
Exactly.
for your future.
Right. This.
So until next time, happy invested, everyone.
See ya.